and I'm also joined by Jed, who is our Senior Investment Manager. I'm based in our UK office where we raise our money, and Jed is based in our office in Nairobi. And we also have Julie on the line, who's going to be just helping us to coordinate and to consolidate any questions that come up. So the way this is going to work today is that we will run through the product that we've launched. Broadly, the agenda is a quick introduction to Energize Africa, then an overview of crowdfunding, just so that you understand how that works, because that's how we raise all of our money. We're going to run through the criteria for the RBF lending product, and then run through some of the product features, how it actually works and what is on offer, before moving on to the process of applying for and being granted lending under this program. And then finally, we'll cover off the costs that are involved. We do want to be in this webinar as transparent as we can about the pros and the cons of crowdfunding, of working with Energize Africa, of the product that we're launching. So we're not trying to sell this to you. This isn't a sales pitch. What we're trying to do is explain this to everybody who's attending, so that you understand as much as you can about the product in the time that we've got available, and then you can make an informed decision as to whether this is something that's worth you taking forward and investigating further and spending your time on. And we'll provide a QR code at the end with a link to the next stage in the process. The product that we're launching and this webinar was put together with input and feedback from the energy access sector. So we're hoping that we've designed and we're presenting something in a way that is relevant and answers the important questions and queries that you may have about the product. So just a little bit about Energize Africa. Oh, sorry, one thing I didn't mean to say. If you've got any questions as we go, could you please enter them into the chat? And what's going to happen is Julie is going to collate those and work out what the themes are, and then send them to me and send them to Jed. And we'll try and have some space to answer some of the questions at the end. The second thing that we'll do is about a third of the way through the webinar, I will hand over to Jed to go into the detail around the product. So I'll have a look in the chat, and then when I'm finishing off on the legals and the terms, Jed can have a look in the chat, and then we can come back on any questions that we think are particularly relevant. And the final thing that we'll do is we'll collate all of the questions that come into the chat, put together a table with all of the answers, and we'll circulate it to everybody who's attending the call today. So just a little bit about Energize Africa. We were set up in 2017 and started trading in 2018. We're a crowdfunding organization, and I'll explain a little bit more about that in a minute. We're very narrowly focused. So we provide debt funding for energy access businesses in sub-Saharan Africa. We don't do any other geographies, we don't do any other sectors, and we don't do equity funding or anything else. So that is all that we do. We were set up with funding and a lot of support from UK Aid, from DFID, the UK Foreign Office, and programs that have been run by the Foreign Office, such as Transforming Energy Access. And we also had a lot of support from organizations like Good Energies, P4G, and Virgin Unite. So there's been quite a consortium of organizations that have come together in order to get Energize Africa off the ground and support it as it's grown. Since we've been founded, we've put together a community of over 5,000 individual retail investors, and we've lent over $64 million through the platform to support SHS, mini-grids, EVs, and productive use across sub-Saharan Africa. Just briefly, some of the organizations that we've been really proud to support over the past 6 years. Electric vehicle businesses such as Rome and BizEdge, SHS organizations such as Bbox, who we supported in the early days of their growth, and Azuri, and organizations that are working across the sector, across SHS and EV, such as Altec over in DRC, as well as C&I businesses like Candy and EPC organizations like Aptec over in Uganda. Particularly want to mention OnePower, a Lesotho-based green mini-grid developer. OnePower were the guinea pig for this product. So we actually raised 3 bonds for OnePower based on exactly the structure that we're going to talk about today over the course of the last 9 months. And OnePower is using that funding to build 12 mini grids in northern Benin. And that was a way for us to test the structure and the legals and to make sure that everything that we're talking to you about today actually worked in the context of an RBF environment where there were forgivable loans, junior debt, and also the results-based finance grants, and to make sure that everything really hung together. So we're very grateful to Matt and the team at OnePower for trialing this with us, and very pleased to say that it has gone very well and that they are making great progress in building out the projects. The funding has come through on time, and the fundraising on the 3rd bond that we raised was very, very quick, as our community of 5,000 investors really gained confidence in this process and in the work that the team at OnePower were doing. I want to talk a little bit about crowdfunding, because some of you on this call may not have engaged with a crowdfunding platform before. The way it works is that we operate a platform, an online platform, where you as the borrower can issue corporate bonds to UK private investors, ordinary people in the UK. We operate the website as a subscription platform, and we act on behalf of all of the bondholders. You have no direct contact with the bondholders whatsoever. We act as security agent, we act as their representative, and we've got a wide mandate to act on behalf of bondholders if, for example, there's any restructuring needed. We also carry out all of the marketing and the fundraising. So once we agree to raise funds for your organization, we'll put together offer documents and web pitches, and we will go to the crowd, and it is us that markets your organization and your project to the crowd. Once the project is underway and repayments start, if it's an amortizing loan, we will then receive the interest and principal repayments, and we will manage the distribution to the bondholders. We also maintain the register of bondholders. So from your perspective, you can treat this as a single lender, and it's Energize Africa that then manages the register and manages the distribution of funds. We are regulated by the Financial Conduct Authority in the UK, so there's a fairly high degree of scrutiny of what we do, and we operate within a very structured and rules-based environment. One of the most important things to understand about crowdfunding is that the investment community that we have are not just in this for financial returns. What they want is they want to put their money to positive and effective use. They do want a financial return. Typically, these are people who believe that lots of the challenges in sub-Saharan Africa revolve around access to capital, and that providing access to that capital is the solution rather than philanthropy being the go-to solution. So it's very, very important when we present companies and projects to our investor base that we can really effectively present the social and environmental impact. And we're very much focused on energy access. So it's that social impact that really comes to the fore, and that's what we're primarily pitching to the investors. So whereas people are looking for a financial return, the impact is equally important to the investors that we have. When Energize Africa was founded, we were primarily focused on lending to SHS businesses that were operating on a pay-go basis. As with many lenders in the sector, we found that the risks associated with SHS pay-go lending were higher than had been anticipated by many, many lenders. We still do SHS pay-go lending. We're just much more selective about it, and we're far more risk averse in that sector. But the reason that we started to look at RBF funding is that it's a way for us as a lender to try and mitigate some of those inherent risks in the sector. So the RBFs are typically structured in euros or dollars, the hard currency, so that removes a lot of the currency risk. And it also means that there is a committed injection of capital that we can rely on for our repayment. We are expecting to see an increase in the use of RBF structures by grant makers across the sector. And we're also seeing an increase in the variety across the different RBF grants and the way in which they are structured, and the different payment structures and milestone structures. So it's not possible to create a single product structure for RBF grants because the different RBF providers, and you see some of them here, are structuring their grants in different ways. So it's really important for us as a lender to be flexible so that we can lend in a way that matches the results-based finance grant and the income that you're expecting from the results-based finance grant, and that we have as little as possible mismatch between the source of debt funding and ultimately the repayment from the RBF provider. I'm going to stop talking and hand over to Jed to talk through some of the much more interesting stuff, the product itself. So starting with the lending requirements and then moving on to some of the features of the product and the actual process of applying and drawing down funds. So Jed, over to you.
Thank you, Ray. Good afternoon from Nairobi. Yeah, I'll talk about the lending requirements for this particular product because it's RBF-backed or PBG if you're in Nigeria. So for us to lend, of course, there must be a signed agreement, and you need to have fulfilled the conditions precedents in the agreements, or you're in the process, because some of them might require, for instance, you get a letter of intent for financing and so on. So yeah, the signed agreement is necessary. If you want to, for example, you're applying for a grant and you have high chances or high hopes of securing it, then you can ask us questions in terms of the financing so that we help you in that process. We are looking at companies or developers that have total assets greater than 500K USD. I mean 500,000 USD in total assets. However, if you have an SPV for that particular project, of course, we are willing to consider the assets of the parent, but that is on a case-by-case basis. Same thing with revenue. The revenue you're looking at is at least 500,000 USD for the last year. We look at it on a case-by-case basis, especially if you have grant income. In accounting, grant income is not really income or revenue, so we are willing to consider some concessions. However, that is very dependent on the case. And then the equity to assets ratio, your skin in the game, should be 25%, and the formula is there. You need to have at least 3 years of audited accounts. If it's an SPV, again, a new SPV, because you formed it for a particular project, then we look at the parent or the sponsor. Then for loan life coverage ratio, definitely you need more than 100% of the loan, because we provide up to 80% of the RBF. So we need to be assured that you'll be able to pay us back. In terms of management and team leadership, we need to be convinced that you are capable of delivering the project. For example, if you've done a previous RBF in Nigeria, if you're in the NEP project, or you currently have something else, maybe under Ascent, we want to see some capability of delivering from a management perspective. Very necessary is environmental and social management systems and anti-money laundering. Those are par for the course in this sector. So we need to have that, you need to have that in place together with, as I said, you need some assurance that you have other funding if required under the RBF agreement. The product features for this facility, we are looking at a ticket size of between 500,000 to 3 million. As I said, we will take up to 80% of the total receivable from the grant. You have 12 to 36 months to repay. However, this is fully dependent on the underlying agreement. If, for example, you are recovering the grant on a rolling basis, we are willing to structure that into the product or into your facility. So it's very, very flexible. You have you can draw down, if for example, you are taking $1 million, you don't want to be paying interest for the full 1 million if you're doing things in stages. So we are willing to look at tranches that are suitable to your project. So between 200 and 750K in terms of tranches, and interest applies only to that tranche. So it's not a full facility unless you take the full facility. For green mini grids, because of the way most of the grant programs are structured, we are willing to look at the bullet repayments. If, for example, the grant is being paid on milestones, then we'll structure the repayment based on the milestones. Same thing with solar home systems, but because they have higher, a lesser period of installation, then we are structuring a 6-month, payment frequency. We are quite flexible on the repayment penalty, or rather early payment penalty, I should say, so that if you're paid by the grant in full within the period you've agreed, then there's no penalty for early repayment. Unfortunately, for now, we can only provide the loan in pounds, simply because that is how, at the moment, we are regulated. And then that means if the grant is in USD, then there might be some small fluctuation between the pound and the USD, and that you need to factor in your model. In terms of process, at the end of this presentation, there'll be a QR code that will take you straight to our first part of the process, which is the pre-qualification questionnaire, the PQQ. It asks for some basic information for us to decide whether it's worth proceeding. And once you pass that stage, we have an initial meeting, basically for us to agree on collaboration and a basic understanding of the product and timeframes. We then move to the term sheet, where we agree on pricing, condition precedents, and so on. Then once that is signed off, we have KYC checks. They are a bit comprehensive. So I think it would be, at this stage, it would be good to be aware that there's a bit more information required, especially for companies that have shareholders with more than 25% control. After that, we now move into in-depth due diligence. Basically, this is for investigative try to look at track record, your ability to survive financially until you're able to be repaid by, we are able to be repaid by the grant. We are looking at your management. So typical things that other financiers look at. And with that also in parallel, we are looking at what's the impact of your project. Not just in terms of CO2, also from a social perspective, how many people are getting electricity, how many businesses are being electrified, and so on, if it's a mini grid, that is. After that, now we prepare an investment memorandum to the investment committee, which makes a decision whether to proceed or not. If they make a decision to proceed, then we move into contracting and loan security documentation. After that, we prepare the offer document. The offer document basically is the document that goes to the investors. And at that time, we are also getting into the pitching methodology internally. After that, the offer documents moves to our compliance team, which is an independent entity under the regulations. If they give us the okay, we now start marketing the bond to our investors. We have some match funding from CEI Africa. It can get up to 50% dependent on the product that you've taken and the amount. And once, of course, the bond is fully funded, we provide the notice to you saying we are now ready to disburse the funds. And afterwards, now it's just a matter of disbursement. I think that's in a nutshell our process. We can get into details for those who require. I'll talk. I think Ray, you can talk about loan collateral.
Yeah, absolutely. Thanks, Jed. I was just keeping an eye on some of the chat that was coming through that's been sent through to the hosts just as Jed was talking. And there's a couple of questions I would like to address just before we move on to the tedious legal stuff. And some questions around the flexibility. So we've tried to take an approach with this product that builds in as much flexibility as we can for the borrower. So we can adapt the repayment profile to the nature of the RBF grant. So if there are milestones within the RBF grants that you expect to meet, if there are 3 different milestones, then we can seek to structure the loan with 3 different repayments. It's not infinitely variable because we're dealing with retail investors, we're dealing with ordinary individuals. So it's very difficult to say to them, you're going to get 27% repaid there and then 41.5% of the next milestone. We've got to have something that's at least fairly straightforward. But within that constraint, we will try and be as adaptable as we can. So we don't just have a single product with, say, 6 monthly amortization or annual payments. We will try and make it work for the RBF that you've got, so we can be flexible there. And in terms of the flexibility around the timing, I think that the best way to explain that is that if you've got, say, a mini grid project that you want to build and you expect it to take 18 months, then what we would seek to do is to set up a 24-month loan note and then allow completely penalty-free repayment after 12 months. And what that allows you is flexibility in both directions. If you have an unforeseen delay, and let's face facts, it happens, then we're not going to have any drama or defaults or cross defaults or anything like that. You've got some flexibility. If the project works well and the money comes in early, then you can repay us early without suffering any penalties whatsoever. And the reason that we're able to do that is because of the unique structure we have as a crowdfunder. The retail investors are happy to get repaid early from their projects because they're impact oriented. If it's been a success and the money comes back early, then people are happy. And the final thing I just want to cover around flexibility is in terms of use of funds. And again, what we've tried to do is structure this so that provided the expenditure is directly related to the project and directly related to meeting the requirements of your RBF grant, then we're happy for it to be covered in the use of funds. We're not taking a kind of assets only approach to this. So we're not thinking of this in terms of our own legal security structure, kind of all assets to venture type approach, because we think the best security for us being repaid is for you as a developer to achieve the criteria in the RBF agreement, get the RBF grant paid out, and that enables us to be repaid. So just want to cover off just that question in terms of the flexibility. And there was one other question that came through, which I think we're about to cover now, about what happens if the donor provided RBF is the donor provided the RBF as security, so there's no risk of non-payment. So I'd just like to run through how the security works and then come back to that to make sure we specifically answer that question. So all of the debt that we offer is secured. We don't do any unsecured debt. In the case of this particular product, the security is, generally speaking, in all assets to venture. So we've got the documents here on the left-hand side. And then what we look for is a specific pledge over the entitlement to payment under the grant agreement, because that's what we're lending against. We'll look for a pledge over the bank account into which the RBF grant is paid in order to secure that. And just for clarity, we're trying to secure over the cash coming in from the RBF grant. What we're not trying to do is control your bank account or control your spending or be a signatory on your day-to-day bank account. That's not our approach, and that's not of interest to us. And then the final thing we'll take security over is the equipment that is purchased with the funding that we provide. The security will all be structured under local law, and as is normal with any of this kind of lending, the costs of localizing the security is borne by the borrower. We have come up with some processes and structures to minimize those costs. So the way in which we've approached that to date is that we have precedent security documents under English law. We circulate those to the borrower and we try and get to a point where we all agree on the terms of the security. So that we don't have any substantive points outstanding. And then we'll take the documents that we've agreed and we'll send them to a local lawyer that we can jointly appoint, and we'll just say, we don't want to change anything, just make these work under legal law, make whatever changes are necessary to have them effective under local law. And we've found that really minimizes the costs involved, which is really, really important for us for this product. Many of you will have other lenders in place. I've seen from the chat, there's some other lenders on this call, which is great. We want to try and work with other lenders in a way that is effective for developers and distributors. Our approach is, and we've been consistent on this, is that we will always share security. If we've got security, then we won't seek to rank ahead of other security lenders. We'll want to rank alongside and not behind, but we will work with other lenders and we will agree intercreditor agreements with other lenders. If you've already got existing debt, we may have to adapt this structure. We may have to look at a carve-out for the RBF agreement because your existing debt provider doesn't want us to have an all assets debenture. And we are open to that. We need to take an adaptable and a flexible approach because the debt structure for every company will be different and we need to work effectively with other lenders. So if you think this product is for you, when you fill in the pre-qualification questionnaire, there's a question there about existing debt and existing security. And we can use that as a basis for collaboration amongst lenders so that you get the best solution for your business. And sorry, I didn't actually cover the question that I said I would cover. So going back to that specific question, so if the RBF is provided as security, then that is exactly what we expect, and that is the structure. The question said if that's provided as security, so there's no risk of non-payment, would the same lending requirements apply? Yes, the same lending requirements do apply. The risk of non-payment for us as an organization is the risk of the borrower either not delivering under the requirements of the RBF or the borrower not maintaining liquidity and solvency during the period that the RBF is in place. So it is very important for us to gain confidence in the financial structure of the organization, in the financial forecasting and planning, and the financial modeling of the organization, and also in the team that's in place, so that we know that the team has the capability to deliver on the project that is being funded by the RBF grant. Want to cover what for many of you going to be the important points here, the cost. At the moment, the interest rate that we're paying to the crowd, so to the individual investors, is 8% per annum. Now, over the period that we've been operating, that interest rate has varied quite a lot. Obviously, during the COVID crisis, interest rates were extremely low in the UK, so we were able to pay much lower interest rates to our crowd, and we were able to pass those on to borrowers. It's something that we need to keep under review. I think we all know that we're in a period of particular uncertainty at the moment, so it's very, very hard to know whether we're going to see inflationary pressures and interest rates going up, or whether we're going to see economic slowdown and therefore banks lowering interest rates. So it will change as things develop, but what we try and pitch that at is an interest rate that our investors see as being fair and reasonable in the context of the impact, the social environmental impact that the project is achieving. Energize Africa charges a one-off arrangement fee of 5%. That's netted off before the funding goes to the borrower, and that's all we charge in terms of our costs of marketing, legal, apart from the security, due diligence, and everything else. And then there's a 1% per annum monitoring fee. We base the 1% on a backward-looking average of the amount that's outstanding over the previous 12 months. So if there's a payment during that 12 months, we will average out the amount that is repaid over the period. And that's the current fee structure. Obviously, it's something that we keep under review. We know from talking to our investors that they want us to structure products so that the fees are both reasonable in terms of meeting our costs and paying them a return, but also reasonable for the borrowers, for the developers and distributors. We do have a few other questions that have come in on the chat, which I'd like to cover off. But Jed, I just wanted to pause there and check with you whether you've seen anything in the chat that you think is any themes developing in the chat, or any particular questions you'd like to cover.
I think there are questions around geographies or countries covered, and relationships with other, not with other, but with the RBF providers. How do we handle that? And then contacts, but that will handle at the end.
So in terms of the geographies, we operate across all of sub-Saharan Africa. We have a few limited exceptions where there are UK sanctions in place and where the Financial Conduct Authority will not permit us to lend. But apart from that, we don't have any restrictions in principle. I can see that the question that's come through references Malawi specifically. And I think that's it's an interesting country to choose. We're very keen to do business in Malawi. The challenge in Malawi is in getting money back out of the country. And that's been a challenge for some time, as I'm sure you're aware, if you're operating there. We're interested in exploring RBF structures whereby there can be an assignment of rights where the assignment to receive the grant under the RBF, or the right to receive the grant under the RBF could perhaps be assigned to Energize Africa. So there might be some direct payment so that we could get around those currency controls and difficulties in extracting money from Malawi. So I think the answer to the question is we're keen to operate across all geographies, and where there are particular challenges that are unique to that country, then we are open to structuring the product in order to overcome those challenges. Turning to the question on how we work with the grant makers, we try to have close relationships with the grant makers during the course of the loan. So for the One Power project that we have funded, all the funding has now gone in to One Power Benin. So we are now monitoring the development, and there are two RBF grant makers there, UEF and CEI. So we're working closely with both of those in order to ensure that that we've got some open communication, and that the parties are working together to ensure that the objectives of the project are met. And for projects that we're in the process of funding at the moment, we've got two new RBF grant bond programs about to launch in the next few days. And for both of those, we've been working pretty closely with the grant provider. And one thing I would like to cover off, because I think it's very relevant in terms of these kind of products, we're trying to explore ways to work more effectively with the RBF grant makers to reduce the due diligence burden on the borrowers. And what we're seeing in this sector is that developers need to go through multiple stages of due diligence, often repeating the same things over and over again. So we're exploring means whereby we can try and access the due diligence that's carried out by the RBF grant maker, and we can effectively piggyback on that, or we can use it, or we can layer on top of that, so that we're not coming back and asking you the same questions that have been asked over and over again. There's a question going into the chat about the pricing, whether that's going to end up in the 10 to 12% range, and that's about right, yes. So the actual rate of interest will very much depend on the cadence of the repayments, whether it's a bullet repayment at the end of 2 years or 6 monthly amortizing, and whether even within that, whether there's some adapting of the cadence that's needed to match the RBF loan. So it's fairly straightforward to model. Once we know what repayment structure you want to work with, then we can put it together and we can run it through a spreadsheet and work out what the effective interest rate is. But you're about right in your estimate. Just looking through, I don't know, Jed, if you saw any other questions. There is a question about the presentation, whether it's going to be available. And yes, we will email a link to the slide deck, and we'll also email a link to the document setting out the questions that have been asked during the webinar and the answers to those questions. And then there's a fun question here asking to clarify how the 80% would be financed and how the repayment works. When the grantor makes the RBF payment into the pledged bank account, will you automatically sweep the full payment to repay the loan, or will the borrower be able to retain the remaining 20% to cover operating expenses? That's a very good question. We obviously would never sweep up more than we are owed. But the question around the process is very important. So what we will generally speaking do is we will seek to be repaid from the RBF grant as it comes in and in priority to other spending. Now, it doesn't always have to work like that. For example, lots of RBF grants pay out an amount up front. There might be a 15-20% drawdown on day one. Now, there's no point in using that to repay debt because it would just be circular and illogical. So there will be an amount that can be drawn under the RBF grant that we wouldn't seek to utilize for repayment. How the remaining 20% works will depend on the structure. Our preference would be that if 100% gets paid in, that we get repaid our debt before the remaining 20% is used to cover operation expenses. But it wouldn't be swept up to us and then repaid back. I hope that makes sense. And somebody has helpfully asked us to share a heads up on the upcoming workshop with RBF practitioners at the Energy Access Investment Forum in Nairobi in 3 weeks' time. So on the 22nd of April, there's a RBF workshop together with NEFCO, BGFA, Catalyst, and Gogla. We're very, very happy to join that and hope as many people that are on this call are also able to join. I think it's vital as we move this forward that the sector works together, cooperates, and collaborates. So I'd just like to finish by, first of all, thanking you for joining and thanking you for your questions and your participation. If you have any questions, then there are a number of things you can do. You can go to the Energize Africa website, or you can point your camera at this QR code and it will take you to the pre-qualification questionnaire, which is the starting point for applying for funding. And you can also see our FAQ on the funding on the website from there. If you have any specific questions, email us at info@energizeafrica.com and one of the team will get back to you. If you fill in the PQQ, generally speaking, we will respond in a couple of days. Usually we'll respond with questions rather than an immediate offer of money. But we will respond and we try and respond quickly if we think that the basic criteria aren't met and it's not something we can proceed with, because again, we're keen not to waste anybody's time. But please do go have a look at the website. You can see the product information there. And as I say, fill in the pre-qualification questionnaire and hopefully we can start working with you and we can start mobilizing some funding to provide you with the working capital that you need in order to unlock those RBF grants. So finally, I'd just like to thank you all for joining. We've reached our time limit. We will be at the Energy Access Investment Forum. Both Jed and I will be there. And I've seen that meetings are now open for arrangement. So if you'd like to meet in person to discuss any of this and you're in Nairobi later this month, please do go to the meetings app and pop in a request to meet Jed or I, and we'd love to see you there. And we look forward to working with as many of you as possible. So thank you very much for joining.